Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Welcome back to our podcast, recording in our 10th year. And we're still at it, still enjoying it as much as we ever have done and trying to help shape and maneuver your thinking in the right way so you can, let's hope, make better property investment decisions. Hasn't really changed in that regard. Our objectives and goals with this podcast, we've stayed pretty consistent with it all. Things are changing all around us, but one thing that stays the same that I see is the best investors are focused, dedicated, have an eye to their bottom line, are always finance ready, and will be ambitious. And that's what I like to chat about. And it's a regular sort of theme of a lot of our discussions. No doubt it will be consistent today. Joining me back in the studio, Steve Ash, founder of Property Strats. How you going, mate? Good to see you.
Yeah, great to be back. And sort of like last time I think we talked, it was you were talking about the 10-year anniversary. So,
yes,
God, yeah.
It's coming up soon. I don't know what we're going to do. Maybe we'll do a big cake or something. I don't know.
Cake, whatever. Yeah,
cake,
Didn't you, when you're saying like the first client you had him back on and he was a mortgage broker?
I did. He was a mortgage broker. Now he's a buyer's agent. Who would have thought?
Everyone's a buyer's agent. Yeah.
He was our mortgage broker back in the day.
Yeah.
A guy called Ross from Aussie.
Yeah.
Aussie Home Loans. He was Aussie's number one mortgage broker. And he sort of won best broker in Australia many years in a row.
Oh, did he really?
Yeah. He was a very good broker. Maybe he was too good.
Yeah, maybe. Well, yeah, he wanted to sort of master the buyer's agent discipline. I suppose that it lends together well. So maybe he's going to be in the Reba Awards then and dominating that.
You know, he's not a bad operator, and and that's a compliment. That's not a bad operator. Means he's pretty good.
Yeah. But I know what you mean.
Yeah. But having that finance background is a great discipline, I think, for being a buyer's agent, and no doubt, you certainly echo those sentiments that we spoke about it last time we got together.
Yeah.
Having that knowledge and discipline in finance.
Well, absolutely. I think with broking, you bring that different skill set to it. Those kind of levers to pull and how to construct that portfolio. So you know exactly the types of assets, whether you need to go hard on sort of like capital growth, obviously to get deposit to buy property or get cash flow. So the lending rules, with the tiers of lender, what sort of levers to pull. So from my stuff and obviously the big investing sort of background, just bringing a little bit of that knowledge and that sort of mix of diversity of assets or whatever, that portfolio construction, asset allocation, and into sort of like what we've just talked about with the broker there, but finding those sort of assets so you can get you sort of up to sort of properties 4, 5, and 6 is so important. So it does help a lot, and I do kind of lived and breathe this sort of industry for about 20 years now. Sort of like from an investing, I always find it fascinating just hearing anything.
Yeah. So go and tune into that. The chat I had with Steve was about a month or so ago. You'll be able to track it down. Just go to smartpropertyinvestment.com.au or wherever you listen or tune in to your podcast. But just recap that very quickly, Steve. We spoke about portfolio construction, and that's a term that fund managers are very familiar with, and people that operate in and around funds management or those sort of financial instruments or vehicles, asset allocation, portfolio construction. So this is where you deploy your money to get the outcome that you want, and typically it's the best return, but it's all about looking at it through the lens of de-risking, so not being too heavy in some area, too light in another area, and shuffling the decks as required in order to get that outcome, which is typically a yield or a return on investment. So the same does apply for property investing.
Well, it does, and if going back to that sort of example, even the big super funds or whatever sort of vehicle or entity it might be, there's always a sort of like asset allocation. So at the moment, trying to think where stocks are. Obviously, we had a bit of a crash with Trump's tariffs or whatever. So you might see a sort of weighting where they're a little bit sort of, you say, 45% in equities or whatever, because they want to. Previously, it was expensive, and maybe an allocation of bonds, unlisteds, infrastructure, whatever, and then they might pivot to go sort of, sort of change that weighting to go sort of long, really, or a little bit more long into equities and up that asset allocation to about 60%. So it's all about getting that right mix to smooth returns, and they all want to sort of stay along with each other. So if we kind of take that sort of analogy and we look at property, and kind of the way I've kind of taken that and had a look at that sort of asset allocation mix, you've got obviously regional type properties, metro, and then I look at all the capital cities, and I think it's good for someone to have exposure to each of them, because if, as you know, like if one capital's doing well generally, or towards the end of the cycle, if you've got exposure to another one that hasn't done so well or underperformed for a period of time, then that will generally do well. So there, if you look at that kind of weighting, you generally you might be underweight those areas that haven't done well, maybe overweight in the likes of Perth and Brisbane recently, because of interest rates rise. Generally, those secondary cities do well and the regional areas do well. But now with rates coming down, it's generally Sydney and Melbourne that do well. So now's the time, if you take that sort of model, to actually go a little bit more into those and increase your exposure to them. And it's just about maybe having more of a diversified portfolio across Australia and treating like those individual areas like asset classes in a fund manager. And obviously then you can break that down into houses and units and commercial or whatever it might be. So that's kind of how I've looked at it a little bit. We had that sort of play. We're talking about Fast 50 before we came on air, and a couple of years ago, obviously it's heavily dominated by Perth, and a lot of people were investing in Perth. So going back to that asset allocation. Now, would you go long or long? Sorry, investment term. There, would you buy more in Perth? Maybe not. Like you go to somewhere where there's a little bit more value, and that sort of lends itself well to that good diversification.
Yeah, and we're going to chat about potentially going long in Melbourne today. It'll be one of our points of discussions where we'll sort of channel a lot of this discussion. But back to this idea of portfolio construction. The way funds management works, it's you don't get too many fund managers that just spray their dough everywhere, right? They'll typically focus in a particular area, and there is such layers of diversification. At the top line in terms of investment diversification, equities, property, bonds, gold, like these crypto, like these big sort of completely seismic shifts between these asset classes.
Yeah.
But to your point, if you choose to go, inverted commas, long in property and be mainly focused in property investment, and that's one of my primary vehicles of investment. Yeah. There are so many layers of diversification in and around that. And what we're talking about here, portfolio construction and asset allocation, is where to put your money at the right time in order to get the outcome that you want. And largely that will be capital growth, but you'll also be done with a lens of cash flow.
Yeah, absolutely. And you want to get into the start of the cycle, because so capital growth is obviously going to is obviously the area that makes you wealthy, and enables you to get the sort of equity to go and keep sort of growing. So I think if we go back to the Perth example a couple of years ago, I think the rules are changing a little bit at the moment. So going back, and I've obviously been listening to podcasts for quite a long time, not to fluff your pillows a little bit.
That's all right.
But you would know all about buying in Moreton Bay in sort of 2019, 2020, or Logan or these types of areas where you could actually get that capital growth and cash flow. I mean, we all kind of had itchy feet in Brisbane for a long time. It seemed to take forever for the old Vegas to take off, all those areas surrounding. But same with Perth, you're able to get those 6% plus yields. But now, because the value's now kind of centered on Melbourne to the point that we were just talking about, and that's where we should sort of look to deploy our funds. We all know that Melbourne has the downsides, like the yields aren't as good. So that portfolio construction, how you're going to actually get to your goals and build wealth, and thinking of that end goal in mind and working backwards, maybe with this passive income, just building wealth, selling down to get your dream PPOR, whatever it might be. When you invest in Melbourne, there's some different sort of rules, because we're talking 4% yields. I'm not talking like the old 6% in. Callinga and these sort of places back in the day.
The game has certainly changed in Melbourne, and it's been rewritten in many ways, and a lot of that is based around property prices and the disparity with that, with yield and people's ability to raise funds for deposit. We'll get into that. Yeah. But I was sort of curious, and I was thinking about this before you come on. If you were going to start again, assuming the knowledge that you've amassed now, would you do anything different?
It's a good question. So I talked to my wife a little bit about it. I believe I actually do a lot better now. There's never a good time to invest. Like as I said when we talked a few weeks ago, I always bring up this story where well, I just bought my first place in 2007, 2008, and it's going to be a property crash. That's all I kept hearing. And so you hear the same things now, but there's always an area where you're gonna be able to get in. So I think taking my sort of like learnings from what I've done over the last 14, 15 years, I think staying away from the subdivisions is maybe the big thing, and not trying to overcomplicate it and keep it really simple, and just get maybe a bit of we were talking about a mix of assets. Like you can get sort of properties in Melbourne or wherever it might be, so with a bigger land component. So we might need a bit of love, a bit tired, maybe have that potential for development later on if that's what you choose to do, but you've got options there. Or you can also get sort of newer type assets that are in quite affluent areas where people want to live that are really undervalued. So having a bit of a mix between those sort of things, but keeping it simple is definitely something I would do if I was starting again. But I'd definitely be looking to those markets to get into just before they've had that exponential growth, and trying to manufacture and make money going into the deal. Yeah.
And that hasn't changed at all.
No.
No. And that's been consistent with property investment since property investment's been going on, right? You want to try and telegraph and understand which markets will move. That's the reason why we do stuff like the Fast 50 and getting in there at a time which is relevant and suitable for you. That might be prior to it started moving, or it may be when the movement starts happening, or it might be somewhere through that movement. So it's all going to be completely dependent on your bandwidth and appetite, the whole property over time, and what those cash flow considerations are. Yeah. But the sooner you are in a market telegraphing what might be a positive shift in capital growth, it's a good time to be there. Then you get 100% of the uplift, right? Yeah. But you might get out halfway through as well to deploy that capital and put somewhere else. So, that doesn't really change with property investors, I don't think. But do you reckon you could have gone harder than what you did?
Oh, yeah. Definitely. Going back then, I used to sort of base all of the sort of kind of scaling the portfolio on one income. And so I used to just think, if the worst case scenario, we're not going to be too sort of affected. But when I look back on that, a much more favourable lending sort of landscape back then, and we could have just done the rinse and repeat, sort of buying the right area, sort of do the sweat equity reno, the paint and the carpets, which was all the rage back in West Sydney back then, and just pulled it out, gone and done.
That's what we did over and over and over.
Well, and look how well they're done. They're all about, they will be 800 to $1 million now.
I've sold most of them.
Oh, you sold most of them? There you go.
And western suburbs of Sydney.
Yeah.
I just sold the last two actually. The other week.
There you go.
Yeah, last.
So you didn't think that Badgerys Creek might be a factor, sort of like where you'd had your growth and you just thought the opportunity
growth, to pull it out. We had a really good place in North St Mary's, right? Which we sold probably a year and a half or 2 years ago, and that was one of the first properties we bought inside that smart property investment portfolio, and it did well. Like I can't remember, it might have tripled in value over the time we had it.
Yeah,
a decade or something or other. You can't. You can't, but you can't compare, right? You're buying stuff back then for a couple $100,000.
Well, it was, my one in North St Mary's, $240,000. And one of the things I've looked at quite a lot.
Have you still got that?
Still got it.
Oh, really?
Still got it. And still the same tenant's still in there as well.
No.
Yeah.
Wow.
Absolutely killing it. He's put a little sort of racetrack in the garden, and I was going to put a granny flat on there, but I'm just too. I can't do it to him. And
like for a car or something?
Like he's got this little sort of go-kart thing that just goes around in the garden, and I just turned. He's been our best tenant, and when we don't raise the rent, we just keep it quite consistent. I know that's not what you should do as a property investor, but he's just been such a great tenant, so we've looked after him.
That's pretty cool. So that'll do well because the whole new sort of train line going through there and all that stuff, out the Badgerys.
I think so. And every time I come to look at it, sort of what you can do with that land, and you look, maybe you could put a duplex or something like that. It just doesn't stack up because it's already grown so much. So what's the point?
Well, this is the point, right? Yeah, you want the market to do the heavy lifting rather than the assets on it, and 80% of your capital growth is got to come out of the region growing, right?
Well, that's it, and the money, rather than spending is better deployed elsewhere, where you're in that sort of West Sydney moment around Australia, where it might be.
We always thought putting a duplex on the place we had in North St Mary's was on a corner. Yeah, you could have easily put a duplex on it. It was built for that. It was bought originally for that in mind, to actually do something with it. I just went, but it was always like, I'll put the money to do that. I'd rather buy another couple of assets and keep moving ahead, right? But it's the point. But it's nice to reflect on what else could be done, because it should help shape your buying decisions moving forward. So just because you are partway through your journey doesn't mean you don't have to. Well, you don't have to keep doing what you're doing. You can actually shift and change, and there's a lot around it. And the knowledge that you've got is going to help you make those decisions. But let's talk about Melbourne. Before we go there, we're going to go to a quick break. Stay with us. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment with Steve Ash. He's the founder of Property Strats. Now, Melbourne, we spoke about it very briefly, and I've got the Fast 50 report here. So where to put your money today for the best capital growth in 2025. You can download that, smartpropertyinvestment.com.au. Melbourne's pretty well represented, or Victoria's pretty well represented. I guess the value prospect in Melbourne, we spoke about it just very briefly. How's the game changed from a portfolio construction point of view? Because you're touching on yields have changed, but there's a lot of other movements in that market.
Yeah. Well, it is. And I mean, just going back to the example we're using, let's just take Calango in Moreton Bay. You picking it up at like 5.56% yield back in the day. So it just made it easier just to hold those assets. And from a lending point of view, you get the capital growth, you get the sort of cash flow with that type of property. So you could just keep buying the same thing technically over and over till you hit your serviceability buffer. Whereas in Melbourne, like with a lot of the areas, let's take Frankston, which Frankston, it might be Frankston South, but let's just take Frankston or Carrum Downs, for example, that's in your report. That's a 4% yield. So that's going to roughly cost you about, before tax, 21 grand based on 100% lend, and after tax and around that sort of mid sixes like interest rate. So if you buy three of those, it's going to hurt, and you're certainly not going to be able to buy much more unless you've obviously got a high payment job. So where the game's changed a little bit is how to mitigate that and get exposure to Melbourne, exposure to that capital growth, and then be able to keep scaling your portfolio. And so the way I kind of see it is that, I don't know, it's a rough sort of formula, but something for your portfolio. And what you can do is maybe get a couple of these, and then the third one has to be that cash flow asset to sort of wipe out maybe a little bit of that negative cash flow in the other two.
Yeah, I guess it's what they call it pigeon pairing, but
pigeon pairing.
Yeah, you used to be able to do it with one. The way that the game has changed a bit is you used to be able to get one sort of capital growth orientated property and match it with a yielding property, blend the two together, and you could cover it. But you need it. You need a bit more cash flow these days to balance these things out, and that's just the nature of prices being a lot higher, disparate to the way the rents have gone up over the years, right? And that's just the nature of the beast now. Yeah.
No, it's a different game, but even looking at the yield in Melbourne, like we're around about, as I was talking about, we're around about that 4%. That's actually quite high for Melbourne. Historically, it's been in the 2s and the 3s. But yeah, definitely, there's a few things to sort of think about with how you do that, and you've always got to be thinking, obviously, a couple of steps ahead of the game on how you're going to get to, and so just. That sort of negative cash flow might just be more pigeon pairing, one capital growth, one cash flow type asset. But obviously you want to be looking with those two to get into number 3, because obviously it's that capital growth that's going to build that wealth and give you those sort of deposits to sort of keep growing your portfolio.
So back to our discussion about the western suburbs of Sydney and thinking about the smart property investment portfolio. Back when we started that portfolio, which we built for the purpose of having an example, we bought
that was awesome.
1, 2, 3, 4, 5, 6, probably 6 properties in the western and southwestern suburbs of Sydney, probably over 12 or an 18-month period.
Yeah,
it's quite a lot quick, and we'd obviously clustered everything together in that same sort of geographic belt. So we're all in on the western suburbs of Sydney.
Yeah.
Would you recommend a similar approach in Melbourne today if you were sort of kicking off and you had capacity? Would you go that, talking about portfolio construction or asset allocation, would you go that heavy there?
It's a really good question. And probably
the numbers are
not.
A lot bigger. The numbers are a lot bigger. So it might not be possible. But
the numbers are, they're definitely a lot bigger. But I think that strategy just works. And then when you're done in West Sydney, you can move on to Logan, as we've just been talking about. Whereas here, I don't think, because you're paying bigger numbers and because the yields are largely the same, I'd be looking, because Melbourne's a massive area, as we all know, like 5.2, 5.4 million population.
Big city.
Sprawls everywhere. And
it's going to keep going and on and on and on. At least Sydney's sort of bound by, the Hawkesbury River and down south it's bound by the national park, and to the west it's bound by the mountains, right? Like Melbourne's not.
No, indeed. So you do need to be a bit more selective in the areas you go in. There's areas up north, like when you go a bit further past Craigieburn, etc. It does. I probably shouldn't say this on a podcast, but it feels a bit like dystopia. The infrastructure's not fully built out. There's house and land packages that go on for ages, and the traffic's really bad in the morning. So it's staying away from those type of areas. But I think getting a bit of diversity around the sort of areas like we're talking about Frankston before we came online in that southeast corridor, that's performed very well this year already, in Carrum Downs and Cranbourne and these likes. But I think it's good to maybe going back to that sort of strategy. If you're getting those two capital growth plays with the same sort of yield, getting one there, and then maybe going one around the north or one sort of in the west southwest, and you could sort of mix up the assets. So maybe something with a bit of land component down the track, or something that's more set and forget type property. Which I know it's comparing apples and oranges, but when you look at sort of the value play in Melbourne and those type of suburbs and the proximity to the city, and you compare it to Sydney. It's just ridiculous.
Yeah.
So I mean, if I look at the Hills District and go up, so we're at 23 to 26 Ks, and you've got the likes of Balcombe Hills, Castle Hill, and say Bella Vista. So Bella Vista with plots, houses on smaller plots, and then 26 Ks southwest, for example, and you've got, say, the likes of Seabrook and Point Cook. Seabrook on slightly bigger plots, and then Point Cook on smaller type plots, like a bit like Bella Vista, not kind of like, there's some sort of similarities, but anyway, but these properties in Point Cook would be around that 750, 800 mark, and Seabrook around the sort of 700, 750, and then Balcombe Hills is obviously.
What's Balcombe about? 1.2, 1.3?
Oh, it's a lot more than that. It's early twos.
Is it early twos for Balcombe Hills?
Late nines, early twos. Well, maybe
Really?
I'm thinking about where I used to live there, but that's my valuation of my old property there in the old Crestwood estate. So yeah. And then,
okay, I know Balcombe pretty well. Is that where is that now?
Yeah,
I was thinking
crazy.
more sort of like Seven Hills, Layla Park. That's probably around 1.2s, 1.3s maybe.
Yeah.
Yeah, okay. Balcombe Hills will be up there, closer to twos. And then Castle Hill, the median up there, if you head up, and then out west, further west to the Bella Vista. See, Bella Vista's got like apartments, and it's got like a lot of new build stuff. What's Bella Vista be? Two and a bit?
God, I haven't actually looked at it for a while, but I think it would be mid to high twos. I think on smaller type plots. You used to go when I sort of bought in there. They were around about that 900 to a mil mark back then, and Balcombe Hills was around that sort of 600, 700 median back then, and just the amount of growth. I think it's been 11, 12% annualized for. So 10
the
years.
Equivalent of those areas in Sydney today, in Melbourne, and you sort of spoke about them, is sort of 700-800.
Well, yeah. Well, like the two areas I'm talking about, and obviously they're not complete like for like, but someone like Seabrook, for example, which is somewhere that goes so under the radar in a lot of places, like close to the station, quite close to the beach, and Point Cook. So Seabrook, I think, is about 780, and then Point Cook's around 810, something like that. And you've got someone like Taylor's Hill, which is more sort of northwest. It's about 26 Ks, really nice area. That's about the mid-eights. Owner-occupier rate is about 91% in that suburb. Very nice, nice area.
More than twice as affordable as what these equivalent areas in Sydney are. And Melbourne will be a bigger Sydney. But Melbourne will be a bigger city than Sydney soon.
Well, the forecast, I think it's like 9.5 or early 9s millions by 2050. So that's almost the doubling of what it is now. So, and when you've got that disparity of prices, so I think Melbourne, in Jan, it was trading at a 41% discount to Sydney. And so just looking at investment sort of vehicles and mean reversion and value, eventually that sort of like gap will be closed because
the gap should be sort of 10-15%. I don't know what it is traditionally.
It's about that.
Is it about 10-15%?
Yeah,
about 15%. Smells about right.
Yeah.
And that will grow and evolve and probably get tighter and closer, over time. But Sydney's always going to have a small premium on it because there is a genuine scarcity of land. There's going to be a point where Sydney is built out, no more space, and then there's suddenly going to be infill.
Yeah.
Whereas you're going to start getting sort of, these micro, you already got them now, these sort of satellite CBDs in Melbourne where, you won't be travelling into the Melbourne CBD for work. You'll be travelling into a CBD closer to your home. Like for example, Parramatta might be to Castle Hill or Baulkham Hills, right? Like
Yeah.
you would travel from Baulkham Hills into the CBD of Parramatta, and that would be your CBD, and that's going to take you 20 minutes probably, in the morning,
Yeah.
maybe 25 minutes. It's not that far.
No.
So that's what you're going to get, and that's the way all these cities will grow and evolve, and that's an important point. And
Yeah, it
investing
is.
in Melbourne is this notion of like satellite CBDs.
Yeah, and those satellite CBDs. I mean, Werribee's is a decent area. Sort of, it's about 30 k's west. Good schools there. Westfield, sort of. You got the Westgate Tunnel, some infrastructure, so that's going to be easy to get in. Melton's another area that's growing quite well in its own right. So yeah, you're dead right. There's probably not. I don't know if it's controversial. I don't think there is another sort of Parramatta equivalent. I suppose you go to those secondary areas like Geelong and Bendigo, Ballarat, but somewhere that's a bit
sort of
closer.
out of town. But you think of Sydney, for example, and rattling them off, sort of these satellite CBDs. You've got Bella Vista now, for example. You've got Penrith.
Yeah.
You've got Campbelltown. You've got Liverpool. You've got Hornsby. You've got Chatswood.
Yeah.
What else am I thinking? There's like, Hurstville.
Hurstville, that was the one that was coming to my mind.
Like it's very much sort of these clusters around these satellite CBDs. Parramatta, for example, is it's one of Australia's biggest cities now.
Yeah.
It's bigger than Darwin. I think it's probably bigger than Adelaide. I'm just plucking that number out, but they're big old CBDs in their own rights, and you start seeing a lot more of that, I think, moving forward with Melbourne. It's going to have to grow that way because it's going to be impossible to be able to, get to the CBD of Melbourne.
Yeah, the way it goes. And I think that's probably a reason with West Sydney, with the growth of Parramatta and why these areas did so well. So, a lot of the banks, I think, didn't CBA go out there?
CBA's out there, NAB's out there, I believe. A
Yeah.
lot of the big accounting practices are now. It's the centre of Sydney, right? Well, Granville, I think, is the geographic centre of Sydney, which is right next door to Para. But,
there you go.
It's
but
yeah.
Yeah.
So what would you say the key pitfalls are investing in Melbourne? Specifically with a view towards cash flow.
Yeah.
The price points are lower comparative to Sydney, and I think you're buying value at the moment. And we'll sort of talk about what might stimulate a bounce back in Melbourne in a moment, because there is some what ifs still there. But where do you see the dangers of investing in Melbourne?
Well, yeah, I think like we're just talking about that cash flow, just something to be wary of, like the out-of-pocket expenses. Obviously, it's been a bit of an unfriendly investor landscape, Victoria in general. So obviously, we've had the land tax that's come in there sort of a couple of years ago. That could get repealed, but I think it's 50,000 is the threshold. So that means any property is going to have land tax. So really thinking about your structuring, how you're going to be buying these properties, what entities to buy in to sort of mitigate that. So
if you're buying in your personal name, there's only $50,000 in land tax thresholds down there.
That's my understanding.
Okay.
Yeah. So let's just say the land value is around 500,000 in personal name. It's there about 1,500 or so, I think it is, a year. But as soon as you go past $1 million in your own name, it goes up. And it's sliding scale goes up even more. So you've just got to really thinking like buying in joint names. Obviously, should never do it, but all of these things you talk to accountants, etc.
Okay. So do you think those pitfalls outweigh the benefits of investing in Melbourne?
Well, there's all not at all. No. I obviously buying counter-cyclical and the value play. Obviously, capital growth is obviously going to get you to where you need to get to, but no, I just think you've just got to be mindful. This is not just a land tax. Like I was saying, it's an unfriendly sort of state. The other thing, and I think this is probably the biggest thing about investing in Melbourne, in the tenancy standards down there.
Yeah.
And I think it's a decent thing to have something like that come through, but it does seem it's something you've got to be mindful of. So if you're getting an older type property, whether it be in Frankston or maybe a Broadie, 16 k's north of the CBD, a lot of these houses have been very poorly maintained, maybe 60, 70 years old. And so now you've got to look at sort of those tenancy standards. So they've got to be electric and gas compliant. That needs to be done every year. You need to make sure, the switchboard's upgraded. There's locks on the windows, all of these sort of things. And so if you're buying a property and you need to sort of factor this in, and it can get quite expensive. And when people go in, and if you're not compliant, you can't rent that property out. So there's a few items there just to be mindful of. So if you're targeting a property and it's currently being rented, then that's generally a good rule of thumb that it is compliant, or the property manager should have been doing the right thing, you'd like to think.
Yeah.
But certainly those I think that's maybe the bigger thing. Everyone looks at the land tax, but this is actually a really big thing. So maybe a newer style property might mitigate that.
Yeah, and there's no guarantees that the regulation governing property investment won't change in the future either. And I think Melbourne or Victoria, if you look back over most recent history, it's been pretty draconian in the way in which it's applied regulation and red tape around property investment. And look, I completely agree. There should be standards for tenants, and obligations on behalf of landlords to provide, credible accommodation, which is safe and all that sort of stuff. However, property investors are seen as an easy target down there for a cash grab to pay the bills, and they've made some pretty appalling decisions down there over the last recent time. I think I don't know what the bill was to get out of the games down there, which they pulled out of. So look, I'll let the politics speak for itself, but there's no guarantees there won't be changes. So if you're going in there, one of the pitfalls is that you need to be aware there may be more overt and onerous obligations on behalf of landlords. Now, what more can they take from us? I'm not too sure. They've pretty much taken, you can't get blood out of a stone, and you can see what's happened in the state of the property market down there as a result of it. But let's remember, the Victorian government raises a lot of funds from property investors and property transactions, so they want to stimulate the market. So, that's the key point. Is it going to happen? Let's have a chat about that very quickly, Steve, but we'll just go to another break. Stay with us, back in a moment. Welcome back, Phil Tarrant, Smart Property Investment, chatting with Steve Ash from Property Strats. How'd the first podcast go, by the way? You get a lot of people call you up and go, I like the cut of your jib. I like this idea around, this investment banking sort of philosophy to property investment.
Yeah, we had quite a few inquiries, and it's one of my sort of I suppose pitfalls. I do like talking property. I wouldn't say I'm as big a nerd as maybe the likes of Munzurl, but certainly had quite a few people call, picking the brain or whatever, and I do like talking. I generally, getting to the point that I've got to in my portfolio where we've done well, but I just. Again, if I can help people and steer them in the right direction, then it's been good.
Do you ever not like talking about property?
Generally, when watching Liverpool playing football,
most of the time.
But I do think, I would say it's not really like the passion about property. It's really investing in general.
Yeah, okay.
And so, I mean, just to go off topic, I mean, I don't know anything about crypto, for example, but I listened to this podcast, and I'm trying to remember. I think it's Kathy, somewhere or other at ARC, and she was just talking about the asset allocation of what's going on in the state. And because I don't understand anything about crypto, but she was saying, like, as soon as a fund manager or one of the big guys, takes a small asset allocation to, say, crypto in their portfolio, because of the way that sort of, funds have to smooth. No one wants to be the laggard, so to speak, in the super ratings or whatever kind of ratings appeal. Like, everyone's going to sort of pick that up. So that could be something that really, not knowing sort of crypto well, that could just that makes total sense to me. If say BlackRock get a small exposure to crypto in their portfolio, then they'll go up. So while I'm really fascinated about sort of property investing, it's really kind of like that sort of building wealth component of it, and trying to teach my son at the moment, which is fun about that sort of stuff.
I took my son to an open home on Saturday, and he's quite curious, even though he's still quite young. So it's good fun. Start him early, I reckon. But to the point around Melbourne, someone taking a small exposure in crypto, everyone sort of follows them because they think they're the gold star standard of asset allocation. So there's a lot of people talking about Melbourne at the moment.
Yeah,
a lot of buyers agents specifically are all sort of looking in that area. Now it will get to a point where it'll be a frenzy of buyers agents in around it, much like what you saw in Perth, and it's seen also a lot of buyers agents operating in and around Townsville, right, where they just go, well, that's where everyone else is, so maybe that's the place to be. I think Melbourne is going to have a little bit of that. It's still very, very early on in the cycle, but what's going to stimulate Melbourne to bounce? Whether bounce back's the right word, but what's going to stimulate Melbourne to actually change the mechanics of disparity between where it sits against Sydney at the moment, because there's and I think in median prices now, Sydney, Perth, Brisbane and Adelaide I think is higher than what Melbourne is. Melbourne should be number 2.
Yeah, and I think it's number 5 at the moment.
It's number 5,
and
so it's out of kilter.
It's way and it's completely out of balance. Yeah. And if I was looking at sort of like the 1 year growth rate, Melbourne's minus 1.7. And you've got Adelaide, I think, is at the top over 10. So it is out of kilter, and it is interesting, the advent of sort of buyers agents and how they do move markets. And certainly I think there is a bit of negative to some of these regional areas. But the interesting thing, because we have seen some areas and markets in Melbourne do very well so far this year. So we're talking about Frankston before. That's really driven by owner-occupiers and first-home buyers. And so it was almost like there was a light switch as soon as the year kind of checked. So last year, sort of November, December, you're getting about 10, 15 groups to open homes in those sort of areas. But as soon as January hit, it was a little bit more, 20 to 25. Then the first rate cut came in Feb. Then it was 50. It was almost a bit of a frenzy, but not with investors. It was actually owner-occs. And so the price has come up quite I'd say 100 or so K in Frankston so far this year. And so, and then you had the knock-on effect to like another one in the Fast 50, Carrum Downs. And that area has done well, and that's quite good sort of knock between sort of owner-occupiers and that rate. But so it's already sort of started. But I think there's a couple of things really that'll sort of stimulate. It would be interesting to see if there's a change of government next year. We've got the state elections. Yeah. Labor have been in a long time. And a lot of the people I talk to when I go back to Melbourne are quite tired of it and think it's time for a change. There's a bit of impact there. Obviously, a lot of people left during COVID, about 80, 90,000 people. So, they got in again. So it'd be interesting to get into another term. But that would really, I think, change the landscape if that happened. Another thing, I just think it's just part of the cycle. So we're talking about West Sydney, talking about Brisbane. At one point in Brisbane, we obviously had the floods, so like 2009, 2010, and Brisbane didn't really do anything for like that. So we had a period where you could get extreme value quite close to Brisbane. You could be in a really nice suburb like say Mitchelton, for example, get a house on a decent plot of land. You know, the prices then were about that sort of 600, 700,000, maybe a little bit more. Around those sort of times, the rent was a little bit lower. And so it seemed quite appealing to Sydney-siders, like people in Melbourne. Yeah, they go and chase that, you know, the Australian lifestyle with the yard, etc. And now Brisbane's has gone too far. I still think there's value in Brisbane for sure with you know the Olympics and the amount of people who've got to go there. But all of a sudden, it's not looking relatively cheap. But there's a lot of like rhetoric in the media about, you know, there's a housing, you know, rental crisis and all of this sort of stuff. When we look at Melbourne, the vacancy rates are quite high in certain areas, but you can actually come back and you can see that there's really good suburbs close to the CBD that are very affordable. And the rent's very affordable too. So I just think that's going to attract people. So the people who've left, we're not talking about going and living in Cooper Petty. I always pick on that one. I don't know why. But
have you been there?
I haven't. No,
I haven't either.
No, maybe one day I'm going to have to do it because I've talked about it a few times. But you can live in a really nice suburb. You can have a 4-bed, 2-bathroom house, and you know the rent's very reasonable, and plus the cost to own it's very reasonable. And I just think it's all part of the cycle, and that will play out, and people will just shift to what's best for their families. And I don't think it has to be any you know kind of special sort of data metrics. It's just common sense really, and I think it's just part of what will happen. And I think that stimulus just that other areas getting too expensive. Yeah,
it's just how long it's going to take, and you may get a change in government, you may not, and you know if you look back to the way in which Australia voted at the federal election recently, the jury's out on whether or not and it depends who you speak to in Melbourne will tell you what they think about the government. Property investors will have a particular view, but people who don't invest in property have another very different view. So, you know, you need to be patient if you're in Melbourne. I'd say you need to adapt a posture of strategic patience in Melbourne.
And I do agree. Like I think a lot of people and a lot of property investors are quite used to. I mean, the big pops that we've seen in Perth, for example. Like I think we must be up. well, certain areas it's going to be 100% in the last 3 years or so, but at least 80. And so you're not going to get that with Melbourne, to your point. Like, well, I don't think you will, but
not that level of accelerant. But you got to remember, it's a very different market to WA. Western Australia was subdued for 20 years.
Yeah.
Whereas, you've got how much of Melbourne's sort of humdrum in this cycle is a result of government intervention through COVID and subsequent to COVID, and the decision making of the government around property investment has had a lot to do with it, right? But it's a moment in time.
Yeah, it is.
You're a numbers guy. You only need to look at the historic averages, and Melbourne. I'm a simple bloke, right? Like Melbourne being sort of the fifth, is it?
Fifth, I think it's fifth.
So Melbourne being behind
Yeah.
Adelaide, Brisbane, and Perth, and Sydney in terms of median value, just doesn't make sense.
No, it doesn't. And this is someone I ask a lot of clients when they come onto the call, and I say, like, if you look at the last 30 years, according to PropTrack data, what has been the best performing city? Obviously, I've said it now. It's obvious what the answer is because it's a loaded question, but it's Melbourne, and it's 5.9% annualized, and everyone would think Sydney. And so,
what's over what period is that?
That's 30 years.
30 years, 5.9% annualized.
5.9 annualized is Melbourne. I think Sydney's 5.7.
Yeah.
And then Brisbane, I think, is 4.8, I think, in third. And so combined, like the capital cities, I think about 5.6 or so. So Melbourne leading the bunch. And then we look at the last 7-8 years, it's been negligible.
Yeah.
And you saw a little bit of a peak in 2021 and it came off in a lot of areas. And that's generally, talking, that's when the government intervened, and the policies and the world's longest lockdown, et cetera, the unhealthy landscape towards investors, all of these sort of things came in. They need to get the cash back or whatever. Stamp duty is a little bit higher. And so all of a sudden a picture's starting to form of what's actually happening in there. So we've got like the best performing capital city over the last 30 years, and it's done nothing in 8-9 years, essentially. So in my small mind, and
maybe the clues are there, right? Not here to give advice around it all, but you need to look at these dynamics, and that's like the Fast 50 report. How do we put that together? We say to people like, tell us where to put your money today for the best capital growth next year, right? And how they work that out is completely up to them. But Melbourne and Victoria, so Ballarat, for example, has been pretty well represented. You can go and download the Fast 50 at smartpropertyinvestment.com.au. Now, I'll round out with this question, Steve. Considering all that in Melbourne, what's a good deal down there? What are you buying? What sort of constitutes a good deal for you in Melbourne today?
Yeah, well, I think, it depends on sort of like the client and the investor sort of mindset. Yeah. So I obviously work a lot with them. Someone wants to set and forget, or someone wants maybe a more active type of investment. So that active type of investment, you getting properties on a good sort of land content. So the median, should have memorized this number before going in. I think it's around about that 780, 790 mark. So if you're buying around or below that sort of median, you've got decent land content. Let's take one from the Fast 50, like Carrum Downs. I think we're talking it's about 710 from memory. So if you're getting a 710, it's not you're not going to get the price in Carrum Downs now, say mid sevens or whatever. The land contents, you're getting land on 650,000. Maybe the house is at the front of the plot. You might be able to carve out the back. The rent there's about 550, 600, and so about that 4% yield. I think that's probably a bread and butter type deal in Melbourne at the moment. We just picked up two in. Like, actually, another thing I should add with Melbourne, like there's been a bit similar to what we've seen in Sydney with a lot of rezoning that's happened, like around train stations here, like around 200-300 metres to the station. Yeah. In Melbourne, there's 20 neighbourhood activity centres that have been rezoned. And so what we've seen is a new sort of zone called the Housing and Transport Zone that's come in. There's two schedules, Schedule 1, Schedule 2. And so Frankston's one of those kind of neighbourhood activity centres like Chadstone, Preston, Broadmeadows, another one. And so within Frankston, almost sort of like that, a number of sort of changes. So if you're picking up land and you're in one of the best high school zones, which is the Frankston High School zone there, and you've got decent land, and you're picking up in the early 800s, I think, 10 years down the track, Frankston's going to look very different. And so if you're holding a bit of land there, you had a decent yield, and you got opportunities to add value down the track. I think that's very good. We picked up one that was side by side. I love my side by side type properties that is in this new zone, and we were able to get that for 1.6 million for both properties. So 620 square meters each.
So 2 properties next to each other.
Yeah. And actually, we had a hidden bonus. Like, so when we actually looked at that, there were 2 dwellings at the back, and we were told there were sheds when we looked at them. They actually turned out to be 2 grannies, and so we were able to sort of do that, and they were actually able to get 4 incomes from that. So actually, where we thought it was going to be around that 3.5%.
So granny
yield.
flats on title, okay to
no, they're on the title and everything, and it was just when we went through and had a look and did the contract review, we realised the agent hadn't picked this up, and we saw it, and it was a bit like
Did you
beauty.
tell them, or you just went, "We'll keep that quiet"?
No, we kept it quiet.
Yeah.
It was a bit of a you beauty moment for the for the investor getting that particular deal. But they can easily hold that deal, and then then we can just wait to see what comes.
So that would yield pretty well then, that play. So those four properties.
Yeah, so that would be yielding. I think it's about 5.5. Okay. In the end with both. So that one's just settled recently. So that's so 1.62 million. That was. So it sounds really expensive, but it's 2 properties, obviously. So one's a corner, one's next to that. So you can
what
get
could
these
you do with
deals.
it? You put a set of townhouses on it or something or other?
Well, yes, it's opposite. It's opposite childcare centre. So you technically you could knock it down, put a commercial vehicle on there, you could put apartments on there, or you could just put 3-level townhouses. And because you've got both plots, you might be able to fit 10 to 12 into there if you were that way inclined. We're talking a lot about my story and messing around with subdivision. I'm not sure the goal would be to do that, but the land's going to be extremely.
But you could sell it to someone that was in that game, right?
Exactly.
That's the point. You don't need to do the work yourself. You're holding the opportunity to capitalise on it, and you can even put a DA in it and do all that sort of work and sell it off as that. But
sell it off.
Fortune favours the brave and the prepared, and most property investors I've seen get into that sort of stuff, it doesn't normally go well.
No.
And that sounds horrible, right? But most property investors, it's equivalent to business as well. Most people shouldn't go into business for themselves. Yeah, there's a good reason why 50% of small businesses fail. Yeah, I would say it's probably consistent. Yeah, in development. Unless you know exactly what you're doing, stay well away from it. No, it's this. You just have to see what's happened over the landscape in the last 2-3 years with the kind of prices going up and the amount of builders, developers who've gone belly up. But mate, they're going bust, and that's what they do for a living.
Yeah. So what hope have you got?
Seriously, it's going to depress a lot of people. But I'm sorry.
And there's going to be some people, obviously, like you say, you kill it. But in this particular play, like you're buying about 400-500 meters to the beach, 300 meters to Frankston Station. You can easily hold that. The land alone on each plot's worth, I think, 620 according to the council rates. We know it would sell for a lot more if it was on market. Yeah. So the land to asset ratios on a lot of these areas, you're basically buying a house for almost free sometimes, or getting a house for free, or maybe just 50 grand, like in a lot of these areas. So that's that, and it's really that almost value play arbitrage, whatever it might be, to construct the same dwelling is going to be a hell of a lot more. So generally, you would see that value realised at some point.
There you go. Well, thanks, Steve, mate. Enjoy you coming in. Thanks for coming down.
Thanks for having me.
Yeah, it's a long way.
It is, but it's always good. Coming down to Sydney, I've left the bright blue skies in Brizzy to come here. But always love coming into the studio and talking. Applying my knowledge around property.
Yeah, nice one. What's the best way to track you down, Steve?
So we've got a new website up. It's quite exciting. A bit of a shout out to my wife. She's a UX designer. She spent tireless work for the last two months getting that all good and running. So propertystrats.com.au.
STRATS.
Yeah, that's it. So it's my old job strat at Goldman Sachs. That's why we've got the name there. We've got Tom Clark on board. He's heading up the commercial area now. He's an absolute gun in that.
You have to bring him in for a yarn at some point.
He's got a. I'm not allowed to say the size of his portfolio, but it's 8 figures and it's massive, and he's done incredibly well. And it'd be good to get him in. Yeah, for sure.
Very good. Well, thanks for coming in and sharing all those insights and knowledge. It's always good to have a chat. And Melbourne. I'm looking in Melbourne at the moment. I won't give too much away. When I do something, I'll let everyone know.
I'm excited to hear what you're going to do.
A lot of people are, but people go, "Oh, Phil's investing in Melbourne, must be the right place now, right?" Like, let me just tell you which suburb it is first. But
and they're going to follow you in like they do with Warren Buffett and stocks.
Maybe. But propertystrats.com.au. Steve's just happy. You'd be happy to just have a chat with people, right? They want to pick your brain and do all that sort of stuff.
Well, yeah. I just we were just talking again before we came on the air. Just want to make sure people do the right thing. Keep it easy. Keep it straightforward. And just stay away from those shiny sort of house and land packages.
We'll leave that for another time. But thanks, Steve. Thanks for tuning in. Everyone, remember to check out smartpropertyinvestment.com.au, social media, Smart Property. You track us down wherever you like to do that. Plenty of other podcasts, wherever you tune into your podcasts, whichever player. A quick favour for me, please keep those reviews coming wherever you listen to this. Team here get a real kick out of it. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.